Good afternoon, this is Drew Erickson talking about money, not math. And today I am again reading a portion of the book that I'm reading, A Missed Fortune, Dispel the Money Misconceptions, Isn't It Time You Became Wealthy by Douglas Andrew. Today we are talking about it's his 8th chapter, and it's the common misconception, lower mortgages resulting in lower payments means lower costs. Or in other words, paying off your mortgage as fast as possible saves you money. Okay, he says that's a myth, and the reality, he says, is that if you take opportunity cost into consideration, low mortgage to home value ratios creates tremendous hidden costs that increase the time needed to pay off a mortgage. Okay, so what he's getting at there, and I'm gonna overview what he says, and then I'll dive into kind of why I think this conversation is important. So basically what he's saying is that if you pay off your mortgage as fast as you can by just putting money into it, you're actually costing yourself money with the opportunity cost, because you would be better off paying the minimums on your mortgage and investing the difference. And once you've accumulated the assets available to buy off your house, you can transfer and do that at that time if you so choose. So rather than paying off your house as fast as possible, pay the minimum, take the extra, invest it somewhere consistently and conservatively, or consistently and then once you've built up, let's say $100,000 of capital in your investments, you can then shift that $100,000, if that's what's needed, over to pay off the rest of your mortgage, and that will actually speed up the process of paying it off, because compounding interest works faster than amortizing interest, right? So let's go through a couple examples, and I'll highlight opportunity cost. Okay, so I'm going to share my screen. Hopefully you guys are able to see it. Okay, so this is what I mean by that. So if you have a mortgage, let's just use a $200,000 example. Okay, a $200,000 mortgage over 30 years at 5% interest. If we calculate that, this person would have to pay I'm just going to round up, $187,000 of interest. Okay, and that's the number that the banks want us to see, and what we're traditionally taught to see to freak us out and scare us. And it's like, oh my gosh, I need to pay off my house, right? And because that kind of stinks, right? You buy a $200,000 house and you end up paying $387,000 for it, plus all the maintenance along the way. So if, I found a number that made all the calculations easy. Let's say you have an extra $177 per month, so to get you up to about $1,200 payments that you could allocate towards your home if you wanted to. So let's say you did that. Okay, you allocate another $177 per month. You'll notice your interest paid goes down to $130,000. Okay, so it goes from $186,000 down to $130,000 just because you allocated an extra $177 per month towards paying off your mortgage faster. Sounds great, right? You did a great thing there. Nothing wrong with that. If we look at the amortization schedule, you're now looking at paying off your home in November 18, 2041 rather than 2049. Okay, so about 22 years rather than 30 years. So the opportunity cost here, if you were to take that extra $177 and spend it on your lifestyle rather than pay off your home, the opportunity cost is the $56,000 or $57,000 that it went down. Okay, so if you're comparing paying off your home faster versus going on a vacation or just lifestyle spending, like going out to the bar or whatever you want to do, whatever you think is fun, then of course paying off your home faster is better, and the opportunity cost of not doing so is $56,000. And so that's where most thinking or most financial planning ends, right there. They see the number, they see what you lose, great. However, what Douglas Andrew is arguing is there's actually even a better way. So rather than taking this $177 and putting it towards paying off your house faster, which is on an amortizing schedule, and we'll review what that means, right? So interest paid in the first month is $833. Interest paid in the last month is $5. Okay, so that's amortizing. It starts high and gets smaller. If you instead invested that $177 and at the same interest rate of 5% to use compounding to your advantage, so $177 per month, in 22 years, that same 22-year period, your money would grow to about $84,000. Okay, so to review, let's just say 3 options. Option 1, take the $177 and just spend it on lifestyle. Okay, go to the bar a couple times or buy Starbucks every morning. Option 2, take the $177 and put it towards your 30-year mortgage and save yourself about $57,000 in interest. Or option 3, take that $177 and invest it in something that gets you a 5% return. Now, of course, these are all just variables for conversation's sake. Nothing here is guaranteed. I just want you to think conceptually. At 5%, and grow your money to $84,000. All right, so option 3, $84,000 of growth is $27,000 more than the interest that you would save on paying your house down faster. Or in a percentage, that is 47% more effective. So it's 47% more effective, or $27,000 better, to invest at 5% compounding than it is to pay down the 5% interest on your home. Okay, so option 1, lifestyle spending. Option 2, save $57,000 in interest. Or option 3, grow $84,000 in investments. Because of compounding, as we see, it gets bigger rather than smaller over time. So I hope today's conversation was helpful. I know I got into kind of some nitty-gritty numbers there. I'm sorry, I'm a very analytical person. That's the way I think. But hopefully the conversation was helpful for you and gets you thinking more and more about what makes the most sense for your personal life, not just what's everyone else doing. Please let me know what you think by leaving a comment. If you enjoyed the video, please like it and or even better, share it with a friend. And I hope you have a great day. Thanks. Bye.